see this year going down in the record books, especially compared to last year?
We are off the charts. So like you said, we've had over 560 IPOs raising $136 billion, and we're only 3/4 of the way through. If you go back 2 years ago to 2019, we had 124 IPOs for the whole year that raised $24 billion, just to give you about the order of magnitude. Now, a lot of that increase has come from the SPAC IPOs, which are mixed into there. But even if you just look at the operating companies, we've already had over 250 operating companies go public this year. So it's really off the charts.
So let's talk about the SPAC attack and the surge of companies choosing that route. How many of these do you think will actually end up being good bets?
This year, we've already had 84 SPAC business combinations on Nasdaq, representing over $200 billion in market cap. And some really great companies, including SoFi, 23andMe, Lucid Motors. So a lot of really big name companies are choosing this. People say, why look at a SPAC versus an IPO? And one thing I like to say is a SPAC is a lot like an IPO, but in reverse. So in an IPO, you'll get all your paperwork together, go back and forth with the SEC, then do the roadshow, set the price. On a SPAC, you set the price, then you go out, do all the paperwork with the SEC, get your shareholder vote, and then you're public. So it's really a lot of the same process, a lot of the same disclosure, but just a different order of operations.
You had your second direct listing for the year this week with Amplitude, the CEO of Amplitude, I guess one of the youngest guys ever to take a company public, joined us on the show. Coinbase was your first of the year. How many more direct listings do you see coming up? Do you see this as being part of a longer term trend, or will these continue to be one-offs?
We are talking to about 10 different tech companies right now about a direct listing. Nobody is planning one for the rest of this year, but I think in 2022, we're going to see this trend continue. As you saw, there were about twice as many companies that did a direct listing this year as last year. So we think this is going to continue. As a reminder, right now for a direct listing, you can't raise capital. So this is really for companies that are well funded through the private markets and are more interested in liquidity versus capital raising.
So let's talk about that. Amplitude shares ended the day up more than 50%. Clearly there was demand there, but they didn't take that opportunity to raise any money for themselves. Was a direct listing really the right call?
You know, they were extremely well funded. They did a private round this summer, and so they had already raised capital. And so this was all about a liquidity event for them, for being able to go out, give their shareholders the opportunity to sell in the open market. And just the way the stock has traded this week has been phenomenal. So they set the reference price at $35 a share, which was right around that private round this summer. We opened the stock at $50 a share, and it's traded within a really tight range between 54 and 52 all week. So it's been traded like a very mature stock very early in its life.
So what are you anticipating for fall?
So we've got a really healthy lineup of deals coming this fall. So we see a lot of technology, biotech, and retail companies getting ready to come to market. I think people are looking to take advantage of the attractive valuations and the amount of capital that's out there in the IPO market. So they want to go out and raise that capital while the window's open.
And if we're seeing so many companies get out of the gate this year, what does that mean for next year? Next year, could we see a slowdown?
Well, I think as long as there's a good valuation environment, which we have right now, we don't see any sign of that changing, although it's been a little bit rockier lately. And that's one of the things we really watch is the volatility index. So we have seen the tech names trade off a bit as interest rates have gone up. So you've got the 10-year hovering right around 1.5%. That's a key indicator for what the future cash flows of these high growth companies are going to trade at. And so if you see the fixed income market start to rise, that could be trouble for some of the valuations we see.
You're also seeing some more switches to Nasdaq from other U.S. exchanges, which I know is a huge coup for you. What's driving this behind the scenes?
Well, so it all goes back to 2005 when the SEC changed the rule where companies could take their stock ticker to either exchange. And so since they've changed that rule, we've had over $2 trillion transferred from the New York Stock Exchange to Nasdaq. One of the more recent ones was Honeywell, which just joined the Nasdaq 100 index, which was a major reason why they wanted to come join the Nasdaq family. But on top of that, we offer really robust solutions around investor relations, corporate governance, and ESG disclosures that companies want to take advantage of. They also love all the branding and visibility they get through a Nasdaq listing.
Meantime, there are some uncertainties about whether Biden's economic plan, for example, will pass. Tax issues that affect a lot of pre-IPO shares and could impact founders in their decisions to go public and seek that liquidity or raise additional funding on the public markets. How much do you think some of these macroeconomic uncertainties will impact the decisions that founders and CEOs are making over the next 12 months?
I definitely think it's driving a lot stronger activity in the private equity-backed companies. So the private equity sponsors are looking at their alternatives between a trade sale or an IPO for liquidity. And with the potential tax changes coming next year, a lot of them are moving to take their companies public this year as opposed to waiting till next year. Just this week alone, you saw Advent International bring out both Olaplex, which raised over $1.5 billion, and then First Watch, a great restaurant brand, on Nasdaq.
And with the pandemic, obviously, we're coming out of it, but you've had more sort of virtual listings, less people coming to the Nasdaq itself to ring that bell. Do you see more of a blended listing day experience to continue in the future, or do you think we will go back to that sort of traditional "we're all here in New York" mentality?
Well, our clients' health and safety is really our top concern. So we've got in place some really good protocols around vaccination and testing requirements for those that choose to come to the Nasdaq market site in Times Square to celebrate. As you saw, both Freshworks and Amplitude had really great celebrations. We also had their employees here in San Francisco at our entrepreneurial center watching the bell at 6:30 in the morning out here on the West Coast. So we're really back to those in-person celebrations, but we're not going to lose some of the virtual offerings that make the IPO day that much more inclusive. We actually have a mobile app now that lets employees around the globe watch the bell ceremony, snap a picture of themselves, and then they can post that picture up on our tower in Times Square for a really unique keepsake from their IPO day.
As we've been talking, Jeff, Rivian just filed for its IPO, seeking to list on the Nasdaq. Rivian, of course, the hot electric car maker. There's a long waiting list for Rivian vehicles. Anything you can tell us about this listing?
We've had a really great run here with the electric vehicle segment this year on Nasdaq. So obviously Lucid Motors, that was another one of those transfers from the New York Stock Exchange when they were acquired by a New York listed SPAC, listed on Nasdaq. Of course, our friends at Tesla, Faraday. So there's a lot of interest in this space right now. And obviously Rivian will be an extremely exciting offering for us this fall. And of course, backed by Nasdaq listed Amazon.